If you've ever even glanced at a stock, you've seen it, the PE ratio. It's pretty much the most famous number in investing. You hear about it everywhere, from cable news to your uncle at a family dinner. It's supposed to be this magic number that tells you if a stock is cheap or expensive. But is it really that simple?
Yeah, that's the real question, isn't it? We're all taught that a low PE is a screaming buy signal. But here's the thing. Sometimes that low number is a major red flag, a warning sign for a company that's in deep trouble, a classic value trap. So today, we're going to pull back the curtain on this famous and maybe infamous metric.
I want you to think about the PE ratio like this. It's like a doctor taking your temperature. It's a useful first step for sure. A fever tells you something is up, but it doesn't tell you what. A good doctor never stops at the temperature reading, and neither should a good investor.
Okay, so let's get into it. Before we can start poking holes in the PE ratio, we've got to be crystal clear on what it actually is and how it works. You have to know your tool before you can know its limits.
At its core, it's actually pretty simple. You just take the current price of one share of a stock and you divide it by the company's earnings per share. The number you get tells you how many dollars you're willing to pay for every single dollar the company makes in profit. So a PE of, say, 20 means you're paying $20 for $1 of that company's annual earnings.
Now here's the first little wrinkle. Not all PE ratios are created equal. You've got the trailing PE, which looks backward. It uses real, confirmed numbers from the last year, so it's reliable, but it's history. Then you've got the forward PE, which is trying to look into the future, using analysts' estimates. It's all about potential, but let's be honest, it's also a guess. Knowing which one you're looking at is absolutely crucial.
And this, right here, brings us to the first major plot twist in our story. A PE ratio, let's say it's 15, is completely and utterly meaningless by itself. It's just a number floating in space. It needs context to have any meaning at all. This is the million-dollar question, right? Is 10 good? Is 50 bad? What's the magic number? Well, the honest answer is, it depends. And what it depends on more than anything else is what you're comparing it to. Just take a look at this. The average PE for a company in life sciences is over 40. That's because investors expect massive growth and game-changing innovation, so they're willing to pay a huge premium. But then you look over at a stable, predictable life and health insurance company, and the average is just 6.5. A PE of 15 would be a crazy bargain in one industry and ridiculously expensive in the other.
And this chart just screams the point, doesn't it? The difference is just massive. It's not about high or low in some absolute sense. It's all about whether it's high or low relative to its peers. This is the very first step in moving from that simple temperature check to a real diagnosis.
Okay, so even with the right context, the PE ratio has some pretty serious limitations. It's kind of like it's wearing blinders. So it's time to talk about what this famous number is completely blind to. And there are three big ones.
First up, and this one is huge, the PE ratio knows literally nothing about debt. A company could be drowning in billions of dollars of debt, and the PE ratio wouldn't even flinch. In fact, all that debt creates massive interest payments, which lowers the E in PE, which can make the ratio look deceptively cheap. It's a classic trap, and it's hiding in plain sight.
Second, the PE ratio is totally stuck in the present. It's a photograph, not a movie. It gives you no clue if earnings are about to skyrocket next year or if they've already hit their peak and are on the way down. And let's be real, investing is all about the future, but the PE ratio is just staring at today, or even yesterday.
And third, PE is based on earnings. And earnings is an accounting term, which is not the same thing as cold, hard cash in the bank. Accounting rules have all sorts of weird quirks and non-cash charges that can make earnings look way different from the actual cash a business is generating.
So, if PE is just the temperature check, what does the rest of the doctor's toolkit look like? How do the pros get around these blind spots? Let's take a look. Okay, so we've established that PE is completely blind to the most exciting part of any company's story, its future growth. So, how do we fix that?
We use the PEG ratio. This is a brilliant little metric that connects the dots. It takes the PE ratio and divides it by the company's expected earnings growth rate. It directly links the price to the company's potential. A stock with a high PE might actually be a bargain if its growth is even higher, and a PEG ratio below 1 often suggests just that.
All right, next problem. What about that huge mountain of debt that the PE ratio pretends doesn't exist? Yep, there's a tool for that too. Meet the EV to EBITDA ratio. Now, this one's a powerhouse.
It looks at the enterprise value, which is basically the value of the entire company, both its stock and its debt, and compares that to its operating earnings. It gives you a true apples-to-apples comparison between companies, no matter how they're financed. It's just a much more honest look.
And finally, we have to solve that cash problem. How do we cut through all the accounting noise and figure out how much actual money a company is making?
For that, we turn to the price-to-free cash flow ratio. This metric does not mess around. It totally ignores those accounting earnings and instead asks a very simple question. How much actual spendable cash is this business generating for its owners? It's the ultimate reality check on a company's health.
So we've got our PE ratio, and now we have 3 powerful tools to see into its blind spots. The real question is, how do we combine all of this into a smart, repeatable process?
Here it is. It's a simple 4-step framework. You start with the PE ratio, but only to compare it to its industry peers and its own history. Then, you use the PEG ratio to see if that price is justified by its growth. After that, you pull out EV to EBITDA to check for hidden debt. And finally, you use price to free cash flow to make sure the earnings are actually real. See, each step is a check on the last one.
Look, if you remember just one thing from all of this, let it be this. The PE ratio is the starting line, not the finish line. It's the first question you should ask, not the final answer you're looking for.
The PE ratio is a simple tool, but as we've just seen, truly understanding a company's value is a much more sophisticated process. So, now that you know how to look beyond that one famous number and use the whole toolkit, what will you analyze first?